Are you brand new to investing or building your real estate portfolio using the DSCR loan? Then you're in the right place. On today's episode, we're going to unpack everything that you need to know when using a DSCR loan in 2026. Let's get into it. Welcome back to another episode of the SCI Mortgage Podcast. I'm your host, Ryan Marks, and we are here to empower those of you who are self-employed entrepreneurs or building your real estate portfolio and don't fit into the traditional lending box. Today's episode, we're going to be talking about one of the most highly used loan programs in the non-QM space, which is the DSCR loan, or debt service coverage ratio loan. So there's a lot to unpack here, and towards the end of the episode, we're actually going to use the free DSCR calculator on the SCI Mortgage website to calculate to see if this particular property would qualify for financing or not. So some of the big things that remain the same with DSCR in 2026 are you can still use this program unlimitedly, meaning that there's no amount of DSCR loans that you can have at any given time and still qualify to purchase another property with another DSCR loan. However, as it currently stands in conventional, you cannot own and finance more than 7 properties using traditional conventional financing. On investment, you're tapped out. So you can look at that one of two ways. You can either build your portfolio knowing you're going to have a lot of doors and build your generational wealth and start with the DSCR loan products and then ultimately move into the conventional loans if they offer better financing terms, or go the other way where once you're tapped out, essentially you're left with the DSCR option. So there's a lot of great things with this type of loan product that are often overlooked or folks aren't unaware of. And one of the biggest things is this loan program does not use any traditional income whatsoever to qualify, meaning you're not providing tax returns, you're not providing W-2s, you're not providing pay stubs. Essentially, you could have no job at all or be a real estate investor or have a job where you have a lot of write-offs, and it won't negatively impact you qualifying for this type of financing in any way, because the loan program is solely qualified based on the property's ability to perform. So what exactly does that mean? Well, so if you took any property, for example, and let's say the mortgage payment with property taxes, homeowners insurance, and any HOAs was $2,000 a month, and it rents for $2,000 a month, that is a 1-to-1 debt coverage ratio, and that's what you would need for financing. You still have to meet some of the basic credit requirements as far as the credit score is concerned and your overall payment history. If you have had defaults or foreclosures, you can still potentially qualify for this product. You just have to make sure that you meet the guidelines and how far out has it been since a prior bankruptcy or prior foreclosure existed. But just know that it's not going to use any of the traditional documentation, and furthermore, there is no debt to income ratio whatsoever on this program. So all other standard traditional loans, they have this debt to income ratio where the amount of debts that you currently have plus your new expenses divided by your qualifying income will give you a percentage, and you have to stay within that percentage. That does not exist on the DSCR loan now, nor has it ever. So using this loan product for the ability to qualify when you're purchasing an investment property is extremely powerful, because it's focusing on how the property performs in order to qualify you for the financing. So some of the changes in this program this year are there are investors that will go as low as a 15% down payment if your property qualifies at least a 1-to-1 ratio, meaning the amount of rent equals the amount of payments or greater in order to debt coverage that loan. So that's huge, because typically when you're purchasing an investment property, especially in the conventional space, you can't go lower than a 20% down payment. So if you're purchasing a single family residence or a duplex, triplex, quadplex, and even 5 to 9 or 9 to 12 units, they have lower down payment options available as long as that property is performing. Some other great things available on that program is even if the property is technically not performing as a 1-to-1 debt coverage ratio, there are no ratio programs still available. So what that means is, let's say again, for example, your mortgage payment is $2,000 a month with everything included, but let's say it only rents for $1,750. Well, that's no longer a 1-to-1 debt ratio. You're actually under that threshold. Now, in certain situations, we work with certain investors where if you're putting a 25% down payment or greater, there's no ratio required. So essentially it could rent for nothing, or you're working to prepare the property to get it up to fair market value and still have access to finance that property in the meantime. Now you have to make sure that it makes sense for you, because often, you as the investor, you want the property to at least break even and appreciate in value, or more importantly, appreciate in value and make you money on a monthly basis. So there are some certain pro tips you can utilize in order to make sure that that property is positively cash flowing. And that's done by a few different ways. One of them being is this loan program has the ability, if you want to utilize a prepayment penalty in order to lower the interest rate, you can take advantage of that. You just need to understand that the property does have to pencil out in the long term in order for you to potentially take advantage of utilizing a prepayment penalty, because you have to remember, if you do pay off that mortgage or pay the mortgage down below a certain threshold or sell the property, you're going to be subject to that prepayment penalty. So those terms can go from no prepay from 1 year all the way up to 5 years. But here's the advantage of utilizing the prepayment penalty. Let's say, for example, you're purchasing a property in a state where, the average price for a home is $200,000-$300,000, or maybe it's only $100,000. And let's say, hypothetically, your interest rate on that property was 7.5% with no prepayment penalty. But if you added a 5-year prepayment penalty, that could bring your rate down into the mid sixes. You would obviously cash flow more because your interest rate is lower, but you're tied into that loan for at least 5 years. So let's look at that from a second point of view. The average closing cost that it takes to refinance a loan, should rates actually drop 1 or even 2%, would it make sense to have no prepayment penalty at a higher interest rate while waiting for interest rates to drop in order to take advantage of that lower interest rate? So let's look at an example of this. Let's say you bought a property for $200,000 and you put a 20% down payment. So you would be financing $160,000. And let's say that at the no prepayment penalty rate, your interest rate was 7.5%, which would give you a principal and interest payment of $1,118.74. And then let's say you bought the interest rate down using the prepayment penalty option to a 6.5%. That would give you a monthly estimated payment of $1,011.30 for just principal and interest, which would give you a difference of $107 a month savings in monthly payment. So now let's look at the closing cost factor. On average, let's just say your standard third-party fees, if you were to take advantage of a refinance, are around $4,500. So if you waited for the interest rates drop 1% from this 7.5% to a 6.5%, that would give you a payment of $1,011.30, which is a $107 difference in monthly payment. But if it cost you $4,500 to refinance to that 6.5%, you would simply take the $4,500 divided by the $107 difference in monthly payment savings, and you would receive 42 months in order for you to break even. So just over 3.5 years it would take you to break even on the cost of refinancing once the lower rates came around, in order for you to break even, versus potentially taking a lower interest rate from the start and locking yourself in utilizing the prepayment penalty. So it has to make sense at the end of the day. I'm not saying that every loan you should utilize the prepayment penalty option, but this is just an example to show you that even if interest rates drop, depending on what the size of the loan amount is, it may not be as advantageous. Now, if you're purchasing a property in the millions, obviously an 1/8 or 1/4% in interest rate decrease can equivalent to hundreds of dollars a month in payment savings, and it might make a lot more sense for you to utilize the higher interest rate up front, knowing that the market's going to eventually correct itself and interest rates are going to drop. So another great thing about the DSCR loan product is there are investors out there now that currently allow you to use your assets in order to create income to qualify or debt coverage your loan payment. So what exactly do I mean by that? Well, this is actually a pretty great guideline that's available, which we work with investors who allow us to utilize this when using the DSCR loan. So for example, if your rent is $2,000 a month, but let's say your mortgage payment is $2,500 a month, you have a $500 delta in order to one-to-one debt coverage. So normally you would have to increase your down payment to likely that 25% or greater, or you wouldn't be able to utilize the DSCR loan unless you use the investor that allows you to essentially dissipate your assets and turn it into income. So what that means is you would take existing assets that you have, whether that's a retirement account, a stock account, liquid assets and checking and savings, and you don't have to use them. You just have to show that they exist. And then essentially we will apply a formula to divide those assets out over a certain amount of months. And whatever that number is now turned into income that you can apply to your quote unquote rental income that you're receiving in order to debt coverage the loan. So just for example purposes, let's say you had assets and after you did the calculation, it came out to an additional $500 in monthly income. Well, now going back to that scenario, you would have your $2,000 a month that you're getting from rent, in addition to that $500 that we created from income, and putting that together would now give you $2,500 a month in rental income to cover the $2,500 monthly payment. And now you're back to a 1-to-1 ratio and qualifying for the DSCR loan. So that would still allow you to go with a lower down payment and still keep you at or likely above the threshold once you dissipate your assets to potentially even receive a better interest rate. The more the property positive cash flows, the better interest rate that you're going to receive. So if you're debt coveraging 1.5 or 2, that's a very high ratio, which is going to look better than just a standard 1-to-1 ratio. Some other things to take into consideration when you're using the DSCR loan is you do not have to have a renter in place. So let's say you're purchasing a property that's vacant and you need to find the tenant. Typically, you have to have a signed lease agreement, first month's deposit, and security deposit shown as cleared in your bank account when you're using like a traditional conventional loan. Whereas the DSCR loan, all you need to do is utilize the appraisal to provide you with 3 rent comparables, which you will then take an average of the 3 rents received, and that is your rental income. In addition to that, they are going to use 100% of that rental income that you receive from the appraisal to offset or debt coverage your loan based on the payment. So those are 2 pretty big, massive differences when it comes to using the DSCR loan versus conventional financing. So just to recap here, if you don't have a tenant in place, the appraiser is going to go out and look at where the fair market rents are based on the property that you're buying. So you're buying a single family residence, it's a 3-bed, 2-bath, it's 1,500 square feet. They're going to go out and see what those properties are currently renting for. And then when you receive your completed appraisal with the value, it's also going to include a 1007 rent comp schedule with 3 rents. So let's say the rents are $1,000, $1,500, and $2,000 a month. Then we are going to use the middle of the road, the $1,500 a month rent, and use 100% of that in order to offset the debt coverage for your qualifying payment based on the principal, interest, taxes, insurance, and any associated HOAs. So in addition to the appraisal piece when using long-term rental income, there is also DSCR loans available for short-term rental income properties, meaning like your Airbnbs or your VRBOs. And how that works is the investor will use the AirDNA data, which you can actually locate yourself by going there and creating an account. And essentially what it's going to do is take your particular subject property and locate other subject properties around the area and give you a number based on how much they think it's rented for the entire year. And then the investor will apply a calculation to that to use the majority of those rents received divided by 12 to give you what your monthly average rent is, and does it debt qualify based on what your mortgage payment is. Some pro tips to understand are, if you're purchasing a property that's already an Airbnb, like you found a property, it's turnkey ready, you don't have to buy furniture, it's got a long history of already renting, we can actually use what the previous rents were if the seller is willing to provide us with that data, and that will give you a much better chance of qualifying using a short-term rental DSCR loan versus just using the comps on the AirDNA. Unfortunately, those aren't 100% accurate. And from previous episodes when we had a real estate agent on, he kind of poked some holes into, how that data is pulled and where, it may be a way to find other ways to locate if the property is going to positive cash flow or not. The good news is you have the choice to go either way. So hypothetically, if the property works as a long-term rental property and you receive the rental comps, you can more than move forward with a rental long-term DSCR loan. And if you choose to make it into an Airbnb at a later time, there's no restrictions in order to do that. So hopefully this has sparked some ideas. If you're thinking about further building your real estate portfolio, or you're dipping your toe into the real estate space for the first time, this is a phenomenal program to use as a vehicle to help you build your real estate portfolio. And for other great tips and tools and resources available, feel free to head over to scimortgage.com, where you can also get in touch with us. We'd love to pencil out your next deal. So if you're on the SCI Mortgage website and you head over to the Tools and Resources tab, there is a DSCR calculator, which is very straightforward. You're basically going to put your gross month rent in and then put your financing information for what your loan amount is, your interest rate, your terms if it's a 30-year fixed, your estimated property taxes and homeowners insurance, and it's going to add those calculations up and tell you essentially where you're at on a debt service coverage ratio. So for example, if you are receiving $2,500 a month in rent, but your overall payment is $2,375, you're only at a 0.62% debt coverage, which is below that 1% threshold. So that would essentially mean that you'd likely have to utilize a 25% down payment or greater, or use the asset depletion method in order to derive qualifying income from your assets to bridge the gap, bringing you up to that 1% or above debt coverage threshold. And there's other tons of great tools and resources available on our website and ways to get in touch with us. We'd love the opportunity to connect with you and help you pencil out your next deal. And until next time, let your income work smarter, not harder. We'll see you on the next one.